Good afternoon, Professor Cho. My name is Dylan Jerosher, and my group chose ExxonMobil. We chose ExxonMobil because we are interested in the global oil crisis and the rising, continuously fluctuating prices of oil. ExxonMobil is an American multinational oil and gas corporation located in Ivory, Texas. They are the world's fifth largest company by revenue. They are the third largest publicly traded company by market capitalization, and in 2014, they were the second most profitable company in the Fortune 500. ExxonMobil was founded in 1999 from a merge between Exxon and, of course, Mobil. Our group will be giving an in-depth view of ExxonMobil's financial ratios. These include the current ratio, the accounts receivable turnover ratio, and the inventory turnover ratio. These ratios will be analyzed, and ExxonMobil will be compared to the competition, including BP and Chevron Corporation. A little side note, ExxonMobil has been criticized for its slow response to its oil spill cleanup in 1989, located in Alaska.
Thank you, Dylan, for the wonderful intro. Hope you're having fun on your cruise in Mexico. Moving on, next we're going to talk about the income statement. The income statement, why it's so important. It's going to give you your overview of your company's financials. Biggest thing you're going to pull out of that is whether or not your company is profitable. Obviously, as a company, that's your biggest goal. You need to be making money and be profitable. Otherwise, your business is not going to last that long. So, starting out, we're going to talk about the total revenue. Total revenue was highest in 2012 with about $450 billion. Unfortunately, the next 2 years it dropped by about $30 billion from 2012 to 2013, and by another 25 from 2013 to 2014. Moving on, your cost of revenue. Unfortunately, the trend was the exact same. Started out the highest in 2012 at about $300 billion, dropped again $15 billion in 2013, and another $18 billion in 2014. Moving on, your gross profit. Obviously, this is a big number here. You want that. It's very important. It's what's going to determine if you can pay off all your expenses and be profitable long term. Started out the highest, 2012, you're right about $150 billion. Unfortunately, again, it dropped by about $14 billion from 2012 to 2013, and by another $9 billion from 2013 to 2014. So, moving on, we have an illustration here of the gross profit trend. As we stated earlier, 2012 started out right around $150 billion, which is a pretty good number. Unfortunately, it dropped the next 2 years, and based on that trend, things aren't looking too good for the next few years. The oil industry as a whole has been really struggling the last few years, as you can tell by gas prices. So hopefully the industry and individual companies can turn things around. Here you have your net income, which is the big number, obviously, that you want to pull off your income statement. That's your final number after you pay off all your expenses. That's going to kind of show your health as a company, how much money you have left after you're covering all the fees and expenses, everything that needs to be paid off. Thank you, Robert, for that breakdown of the income statement. It was fantastic. It was clear, concise, it made it simple. God, I wish more people were like you. Moving on, we're talking about the balance sheet next. So, obviously, big focus here is the assets, liabilities, the stockholders' equity. Total assets for Exxon, pretty interesting. It's kind of the opposite of what we saw in the income statement. Everything increased. So, 2012, you had $333 billion worth of assets. That increased by about $13 billion to 2013, and by another $3 billion to 2014. Obviously there, the big jump is from 2012 to 2013. Moving on to your liabilities. Total liabilities right here. Started out about $167 billion for 2012. Same thing, you get the bigger jump from 2012 to 2013. You went up by about $5 billion and only by about $2 billion from 2013 to 2014. As you can see, we have a chart here, kind of just illustrating what I had said earlier. As you can see, there's not a ton of movement. Obviously, more of the movement is from 2012 to 2013, and from there, it kind of stabled out for the year after that. Interesting point on Exxon, 60% of their assets are actually invested in plant, property, and equipment. Obviously, you'd expect that to be a high number due to the fact that they extract all their oil and things like that, so they're going to have a lot of money there. I just personally didn't realize that it would be, the majority of their assets. And last point, approximately $10 billion in shareholders' equity. Again, much smaller, one of the smallest parts of the company.
Thanks, Rob, for the breakdown of the financial statements. Next, we're going to dive into some of the ratios and analyze their trend over a 3-year period. First, we have the current ratio. This measures a company's ability to pay short and long-term obligations. The higher the current ratio, the more capable the company is to pay off those obligations. This also gives a sense of efficiency of a company to turn its product into cash. So it really has to do with their liquidity. As you can see here, from 2012, they started with a ratio of 1.005, and as they move towards 2014, it's a trending downward. Next, we have AR turnover, which is found by dividing sales by your average AR. This is an accounting measure used to quantify a firm's effectiveness in extending credit and also collecting debts on that credit. So, high receivable turnover could mean a variety of different things. This could mean a company's operating on a cash basis, or maybe they just have conservative lending policies. So trends from here, we started at 13.10068 and we decreased slightly, and then in 2014 we have a slight increase. Next is the inventory turnover ratio. This shows how many times a company's inventory is sold and replaced over a period of time. Low inventory is a bad sign because that usually means that products are left sitting in a warehouse. So here again, we have a straight declining trend from 2012 to 2014. Next, we're gonna show this graphically with a visual. There's the current ratio. It's decreasing from 2012 to 2014. The accounts receivable turnover ratio, we had a decrease from 2012 to 2013, and then it increased from 2013 to 2014, and then here, steady decrease from 2012 to 2014.
Thank you, Nick, for that excellent breakdown of ExxonMobil's ratios. Next, I will be going into ExxonMobil's competition. We decided to go with Chevron Corporation and BP PLC. A little background on each company. Chevron is an American energy corporation headquartered in California, engaged in every aspect of the oil, natural gas, and geothermal energy industries, including hydrocarbon exploration and production, refining, marketing, and transport. It is 16th on the Fortune Global 500 list of top 500 corporations worldwide. In 2010, it sold an average of 3.1 million barrels a day of refined product. BP, known as British Petroleum, is headquartered in London, England, and in 2010 it sold an average of 3.2 million barrels a day. In 2010, it was known for having the largest accidental spill in the marine waters. Exxon, on the other hand, is the second on the Fortune 500 as the most profitable company. Now, we decided to take a couple ratios, ROA, return on assets, profit margin, and debt to equity ratio to compare these three companies. A little bit on each ratio. ROA is displayed as a percentage, also known as return on investment, and it measures how profitable a company is relative to its assets or the resources it owns or controls. It allows investors to measure how efficient management is at using a company's assets to create earnings. The formula to calculate it is net income over total assets. Now, as you look over here, we have ExxonMobil, which in 2012 had a roughly 9.4% return on assets and has increased to 13% since then. The industry average, if you look for the oil and gas companies, is around 8.2%. Now, Chevron in 2012 had about a 7.67% return on assets and has increased to 10.4%. The BP, doing the worst out of the three, had approximately a 0.5% return on asset and has increased to 1.3 since then. Now, if you look at the chart here, we have the industry average in yellow, roughly around 8.2%. We have BP barely hovering around 2%. Then we have Exxon, our company, being the highest, around 13% at its highest point, and Chevron cracking the average and then being above it recently. Now, if we go to profit margin is net income over revenue, displayed as a percentage ratio of income kept in company as compared to total revenue. measure. It's basically a measure of profitability. It's a measure of efficiency and financial health. So if you look over here, the industry average for an oil and gas company is approximately 6.1%. We'll again look at ExxonMobil, has approximately in 2012 an 8.3% profit margin and has increased to basically, if you round, 10% profit margin in 2014. If you look at Chevron, we got 9.6, and then in 2012, and then in 2014 we got 11.4. BP again lagging behind with a 1.3 in 2012 and a 3.2 in 2014. Now if we go again to the chart here, to the graph here, industry average roughly 6%, and we have BP cracking the average in 2013, has gone down since. We have our company Exxon steadily increasing its profit margins, but we have Chevron exceeding the average by a lot and beating our company too, and doing better around almost 12% profit margin. Sorry for that technical difficulty, but we'll get right back into it. The last metric we're looking at is the debt to equity ratio. It's essentially the measure of a company's financial leverage, and the formula is total liabilities over shareholders' equity. It's also known as risk. So it's the debt relative to total value of a stock. So you gauge the extent to which a company is taking on debts as a means of leverage. This is an attempt to increase its value by using borrowed money to fund various projects, but by doing so, it is associated with higher levels of risk. So if we look at our companies that we decided to go with and the industry average for the oil and gas companies, we see that the industry is around 0.6, which essentially means there's 60 cents of liability for every dollar of equity. Now, if we look at Exxon, it's in 2012 it has a 1, which essentially means there's a dollar of liability for every dollar of equity, and it decreases slightly in 2013 and then back up in 2014. So it's hovering around that 1-to-1 ratio there. For Chevron, it's actually closer to the average in 2012 with 72, and then in 2013 it drops, and then in 2014 stays around the 70-71 range. For BP, fortunately, they have a little bit of a higher debt to equity ratio. They're averaging around $1.55 of liability for every dollar of equity they have, making them higher risk. It decreased a little bit in 2013, but went back up to around 154 in 2014. Now, if we look at the chart, you can see the average. Fortunately, all three companies in this sector are above the average. So the 0.6 is here. Chevron the closest, getting closest to the industry average. Exxon close behind, and unfortunately, again, BP not doing the hottest. And that is the analysis of the competitors. Thank you, Dr. Cho, Professor Cho. Have a good night.